In this video, I'll let you know what you need to know if you need a self-employed mortgage. Who are self-employed mortgages for in the UK? When it comes to a mortgage in the UK, you're classified as self-employed if you're a sole trader, whether that is as a shop owner or a tradesperson. If you own a limited company and are a company director, you will also fall into the self-employed category when it comes to getting a mortgage. If you're a contractor, you could fall into either being a sole trader or a director of a limited company, depending on the way you have been working. Depending on the length of time you have been a contractor, you may also be assessed as employed. As a self-employed person, you will be eligible for the same type of products as you would if you were employed. You will have the same benefits and features available to you with most lenders. The main difference is that you will be assessed differently. So if you are a sole trader or the owner of a limited company, mortgage companies will define you as self-employed, and this will lead you to being assessed differently than those that are employed when it comes to getting a mortgage. What is the difference between a normal employee mortgage and a self-employed mortgage? When it comes to the deals, features and incentives available for self-employed mortgage, the good news is they are the same as a normal employee mortgage. The differences are dependent on your type of self-employment, whether you're a sole trader, limited company director or a contractor. Each of these will be assessed slightly differently, and I have made shorts on how you will be assessed. The longer you have been trading, the more evidence you can supply. This all helps you get a mortgage easier, even with a lower deposit. Should I go to my broker or my bank for a self-employed mortgage? As a qualified mortgage broker, I'll let you figure out who I'd recommend. If you go to your bank, you may be asked to produce less documents if you already have a relationship with them. They will not charge you to apply for a mortgage. You will only pay a product fee if they recommend a product with a fee. When they meet with you, you will have an appointment for 2 hours and complete a fact find at the bank immediately. You will be limited to the products that they offer. You will have to fit into their criteria, and if you don't, you will not be able to get a mortgage with them. They will not liaise with solicitors or anyone else within the process if there is a problem. That will be up to you. This can be quite stressful. If you go to your broker, your initial consultation will likely be free. At that meeting, they can help you understand how much you can borrow and what is affordable for you. Brokers can discuss what is important to you and can explain what you can expect from the process. This can give you the information you need to decide whether you want to move forward or not without having to gather all the documentation that you will need to apply. It is a good idea to have your credit report when you speak to them. This will help them know if they can assist you or not. More brokers charge a fee if you use them than don't. This can be as little as £295 but can be as high as £2,500. Depending on the broker and the service you require. You will be asked for more documentation when you first meet a broker. They are regulated like the banks and have a duty of care to provide you with the best advice they can, and they have to justify that advice. A broker, whether they are with a network or an independent, will have more lenders to choose from, which provides you with greater choice. If you do not fit the criteria of one lender, they have alternatives that you can qualify for. When the process is not going as planned and problems arise, a good broker will talk to solicitors, lenders on your behalf and make the journey smoother and less stressful. How much can I borrow for my self-employed mortgage? This depends on your income. Your proven income will then be multiplied between 3 and 5.5 times to give an idea of maximum lending. The combination of your multiplied incomes minus expenditure will be used to provide you with a maximum amount that you can borrow. If you have an adult and or child dependents, this will also affect how much you can borrow. Lenders will use the information in both business and personal bank statements to assess your current expenditure to make sure that the self-employed mortgage you're applying for is affordable. What deposit will I need for a self-employed mortgage? The minimum deposit that you will need for a self-employed mortgage is 5%. This is currently backed by a government scheme. To qualify for this scheme, you will have to have a very good credit rating. The more that you can afford to put down as a deposit for your self-employed mortgage, the better the chances of you being accepted. Additionally, the interest rates offered will be more competitive and beneficial to you because the loan compared to the value of the property will be less. In England and Wales, you can apply for Help to Buy, a scheme which will provide you with a 20% deposit towards a new build property, but you will have to provide a minimum of a 5% deposit. In London, the Help to Buy scheme offers a deposit of up to 40%. This has proved popular support for first-time buyers, as this shared equity scheme reduces the interest rates charged by lenders. Another options for first-time buyers looking for self-employed mortgages are shared ownership schemes. These schemes vary from region to region, but these allow you to purchase part of the property and lease the rest by paying a monthly rent. These schemes will also reduce the amount you would need for a deposit. In Northern Ireland, depending on your situation, a self-employed person, you may qualify for a mortgage on co-ownership, a shared ownership scheme, and may not need a deposit. What costs can I expect when applying for a self-employed mortgage? Depending on the cost of the property that you intend on purchasing, you may need to pay stamp duty. The higher the purchase price, the higher the stamp duty you will have to pay. Product fees. These are fees that the mortgage lender will charge to get a better rate. Sometimes paying these will be advantageous over the term they are taken. It's best to get advice from your broker or your bank regarding these. These can be up to approximately £1,995. Broker fees, these can be as little as £295 or as high as £2,500 depending on the broker and the services they offer. Conveyancing fees, these are the fees that your solicitor will charge when creating your self-employed mortgage contract. If you're paying less than £1,500, you're doing well. These fees will include bankruptcy searches and disbursements costs and more. Get a quote from your conveyancer stating what they will charge so you do not get a surprise bill on completion. Do I need to take out insurance to get my self-employed mortgage? The only insurance you are contractually required to take out as part of your mortgage is building insurance. Contents insurance is available but not a requirement of the mortgage. Other options available to you are life insurance, which is designed to clear the mortgage debt on death, as well as other individual needs. Additional insurances to consider for your self-employed mortgage. Critical illness cover. This type of policy provides a lump sum which can be used to clear the mortgage debt on diagnosis of a critical illness. These policies will pay out on a defined critical illness as stated in the policy document. These definitions will vary between insurers. Approximately 80% of all critical illness claims are for cancer, heart attack, stroke and multiple sclerosis. Income protection is sometimes people referred as people's insurance or a personal furlough scheme, mainly because it provides you an income to replace lost income if you're unfortunate to be off work as a result of an accident or an illness. This policy pays an income from as soon as the first week up to retirement, depending on your needs. This is more comprehensive protection policy as it will cover all illnesses, not just defined critical illness, so long as you've not had a pre-existing condition before taking it out. Additional types of protection are also available and you should discuss these with your qualified mortgage broker or bank. Life insurance, critical illness and income protection are designed to mitigate the risks of you losing your family home due to adversity. Just because you're not contractually obliged to take these policies does not mean you should ignore their existence. Are there any impacts from COVID on my self-employed mortgage? The short answer is yes. Since COVID, the most self-employed mortgages are written on a case-by-case basis. This means the underwriter will look at your circumstances individually. They will look at the industry you're in to see whether or not you've been impacted by COVID. They will take into consideration whether you've had a cease grant or a bounce back loan. Just because you've had a cease grant or a bounce back loan does not mean that you will automatically be turned down. The lower the loan you are requesting to the value of the property you are buying, the better the chances of being accepted for a self-employed mortgage. The higher the loan to the value you are requesting, the higher the chance of being turned down. It is best to speak to a qualified advisor to discuss your needs when applying for your self-employed mortgage. If you find this useful, please subscribe so you don't miss out on other videos. Mortgage warning. Please note that we have to let you know that your home may be repossessed if you do not keep up repayments on your mortgage.